Alrighty. So in today's video, I am going to be sharing with you guys 5 secret hacks to help you become more consistently profitable when it comes to trading credit spreads. Now, these are 5 things that I actually do not see that many people use in their trading, right? So these are 5 things that I personally employ in my own trading, and I'm seeing very consistent results. And I truly believe that if you were to use these 5 things I'm about to share with you today, these 5 hacks, you too will be able to get much more consistent results as well. So if you have a pen and paper, just take that and just take as much notes as you can. Okay, so let's get into the very first hack. So the very first hack is to trade only index ETFs. Now, if you have been a follower of my channel for some time, you will notice that I really like trading index ETFs, and that is one of the reasons why I'm getting pretty consistent results, right? So why is it that trading only index ETFs is going to help you become more consistently profitable? Right? The very first reason is that index ETFs do not move as much as individual stocks and tend to stay in a narrower zone. So when we are trading such kind of strategies like credit spreads and even other spreads, right, like the Iron Condor, basically these are premium selling strategies, we generally do not want the market to move that much because a lot of the time we are focused on having the spread decay over time, right? We're also using theta decay. Now, credit spread is a directional trade, but it's also a neutral directional trade, which means to say that even though if the market does not move, we are still going to profit over time, right? So that is why we do not want the underlying to move that much as well. And if you were to compare this with individual stocks, you can see down here, this graph over here is done by the Tasty Trade team. So they've done a lot of analysis and research into this, and you can see that when you compare the ETFs to the stocks, the ETFs actually stay in a much more narrower range. You can see this is the standard deviation move. So you can see this is much more narrow for the ETFs, whereas for the individual stocks, you can see it's much more wider, right? The moves are much more wider. Now, yes, if you were to trade the credit spreads and the market is actually to move, in the direction that you want, right? Let's say, for example, you enter into a bull put spread and the stock, right? Let's say you get into the individual stock and the stock just shoots all the way up. Then yes, you're going to start to profit, pretty quickly on your credit spread, right? On your bull put spread. Now, the thing with this is that although you could profit very easily, you could also lose very easily if the market actually goes down. So that is why with index ETFs, although if the market actually moves against us, right? Let's say, for example, you trade the bull put spread in this case as well. If the market goes down, it doesn't move that strongly compared to individual stocks, right? So that means to say you actually still have a chance for the market to rebound, and the losses will not be as big as compared to stocks, right? Because the stocks, individual stocks can really move that violently. So the other reason is that index ETFs aren't affected as much by earnings of any single stock in its composition. So the reason why I like index ETFs is because there is no earnings to really affect the price move of the ETFs. So I can, just continually put them on when I see, it's time for me to enter into a bull put spread. But if there's earnings coming out for individual stocks, then, this is where it becomes a little bit of a 50-50 shot, because the research done by the Tasty Trade as well, they have shown that, if you were to trade earnings, the results are pretty much 50-50 as well, right? Although the volatility increase, you also have increased risk in terms of the movement, right? The market can really shoot one direction or another when the earnings comes out. So again, this is why index ETF is a preferred vehicle if you want to trade strategies, basically premium selling strategies. Now, next, index ETFs aren't affected as much by individual stock news, right? Let's say, for example, a stock has a bad product launch, then that's going to get very, very negative sentiment and the market is going to plunge, right? Pretty much a lot of times whenever there's some bad product launch or there's a product recall, then the negative sentiment is going to take over. The market is going to see this as very bad news and they're going to just dump the stock. So imagine if you already have a bull put spread on, then that's going to go way past, most likely it's going to go way past your credit spread. But for index ETFs, the effect is not going to be that much, right? It's going to be pretty muted. Again, because there are many stocks in its underlying. If you trade the index ETF, I generally think that you're going to have much more consistent results in your P&L. So this is something that, as you can see, I really employ in my own trading strategies. In my own trading, I mainly trade the index ETFs when it comes to trading spreads. Okay, secret hack number 2, and that is to exit at 21 DTE regardless of the PNL. So exiting at 21 DTE is a study that is already done by the Tasty Trade team, and they have already shown that exiting at 21 DTE is much more superior than if you were to exit at expiration. But for some reason, many people still want to hold all the way to expiration because they think that by holding to expiration, you can actually realize the maximum profit of the spread, right? I mean, why would you want to take it off early when you could hold it for slightly longer and then you can realize, the max profit of the trade, right? So it doesn't make sense straight away just by exiting at 21 days, right? So here's the thing, right? Why do you want to exit at 21 DT? So again, the Tasty Trade team have already done all this research, and this research is over numerous years, right? So they have many data points on this. They have many trades. So that is why, exiting at 21 DT is going to show that you're going to have better long-term performance, which means also higher returns compared to holding till expiration. So as you can see down here, this is based on a put spread. And although the win rate is higher for holding to expiration, which makes sense, right? Because you hold it longer instead of cutting off earlier. If you cut off earlier, what happens is that your profit zone is going to be narrower. But here's the interesting thing, right? Although you cut it off earlier, you notice that your return is actually higher, right? You can see that, based on a $5 wide put spread, if you were to exit at 21 DT, your return is 47% compared to 33%. Right, for the $10 wide, right, similar as well, 40% compared to 33%. And the reason is because you actually manage your average losses much better. When you exit at 21 DTE, what happens is that you're actually cutting those losses, which would have actually, become a max loser at expiration. Well, you cut it short, right? You cut it much shorter so that, you can see that the losses are much more smaller compared to if you were to hold all the way to expiration. Now, of course, there will be certain times whereby, you cut off the trade early, it's a loss, but if you held all the way to expiration, the trade may actually come back and you're going to be in a profit, right? But remember, we do not want to take a look at each individual trade, right? Each individual trade is just a point in data over a span of many trades. So we want to look at the big picture. We're going to look over 100 trades, over 500 trades, over 1,000 trades, right? So in this case, this is where you want to lean on statistics, lean on data. And as you can see down here, this is the statistics or a study already done by them. And you can see if they were to manage at 21 DTE compared to, holding to expiration over the long term, right? Over a decade long, right? In this case, this study is from 2006 to I think around 2020 or something like that. You can see that 21 DTE eventually outperforms the holding to expiration, right? And even though, let's say for example, they do end up with very similar results, what you will notice is that the volatility in your P&L is going to be much lesser, right? P&L in your volatility means the swing in your P&L, right? The last thing you want, right? Let's say for example, this is your P&L volatility. This is in terms of dollar, and this is in terms of number of trades. So if, for example, you're going to have a P&L that goes like this, it's going to be so volatile, right? At one time, you're going to be profiting that much. After that, you're going to drop so much. And after that, you're going to make so much again. Compared to, you have a much more smoother P&L over the end of the day that reach your end goal, right? Which would you prefer, right? For me, because we are all humans, and a lot of times, many of us cannot avoid looking at your P&L when you're actually trading it. You could actually get affected by it, right? And when you're affected by it, that's where it will affect your decision. And that's where many of the times it will lead to wrong decisions. So when it comes to trading especially, we want to be as mechanical as possible and not, try and be discretionary, right? The last thing you want is be too discretionary, and then it's going to be very difficult for you to, have a proper, determination of whether you're going to do well in the future or not, right? So as you can see, the studies have already shown that 21 DT exiting is going to have a better performance than holding to expiration, right? So it significantly reduced the risk of early assignment as well, because there's always a chance that if you have any options that's in the money, right? Let's say, for example, you put on a bull put spread, right, -1 put and +1 put, and let's say for example the market actually goes down here, and you're hoping that the market would come back up, right? Now what happens is if there's very few days left to expiration, right? Let's say maybe there is 7 days to expiration. Well, this is the time where there's always a possibility for you to get a sign. And if you're going to get assigned, it's going to get very messy, right? Because imagine this, if the market goes down and before the market has a chance to actually recover, you're actually assigned. So all of a sudden, you do not have, one shot put. Instead, what you have is 100 shares. So what's going to happen? 100 shares means that you have to fulfill this obligation in terms of our capital. And if you do not have the capital, then this is where you're going to get into margin call. The broker is going to call you and it's going to get very messy. So this is why it's much more better in terms of objectivity to just exit at 21 DTE. Remember, we are going to have some losers as well as, we're going to have winners. Most of the time, yes, if we are going to put on, let's say, a 30 delta put spread, then the win rate is going to be 70%, right? But that also means that 30% of the time you're going to lose money. So you do not want to force a winner for every single trade that you put on. Next, it keeps your trading mechanical instead of being discretionary, which can lead to analysis paralysis, right? So how many times have you actually put on a trade and just wonder, should I hold on to it? Should I exit it? Is this P&L enough? Is this P&L too little? So to avoid all that stuff, exiting at 21 DTE just makes it mechanical, and you just lean on the fact that the research has already been done. The statistics have already been proven that you can actually get better results than holding to expiration. So just lean on that. Now, you might be asking, if we were to exit at 21 DTE, right? Let's say, for example, if you put on at 45 days and you were to exit it at 21 DTE, that would mean that you're effectively holding it for only 24 days, right? So if that's the case, why not just trade a shorter DTE and hold to expiration, right? Basically just hold the 24 DTE all the way to expiration, trade this DTE instead of, putting on 45 days and exiting at 21 DTE. So that is a very good question. And in fact, this is a question that the Tasty Trade team actually gets a lot. So that is why they have already done a study on this, right? So they did a study to compare trading short duration versus, exiting at 21 DTE. So you can see the blue line down here shows that you enter at 45 DTE and you exit at 21 DTE. And the gray line down here is where you basically just hold to 24 DTE all the way to expiration. So in terms of holding the number of days, the trade is the same. But you can see that the performance of the 45 DTE and then you exit at 21 DTE is so much more superior than if you were to trade, just the 24 DTE and hold to expiration. So if you're wondering about that, well, I hope this have resolved your question in your head, and just go ahead to do the, the longer term one and then just exit at 21 DTE. Now, the next hack is to trade price extremes. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So what do I mean by trading price extremes? So basically, trading price extreme means to only enter into a credit spread when the market has made an overextended move, right? Either to the upside or to the downside. And the reason for this is because credit spreads are actually directional trades. Basically, you want it to move in the opposite direction of where your trade is. So if you put on a bull put spread, you want the market to generally go up. And you put on a bear call spread, you want the markets to go down. And one thing we know also is that for price action, price do not just move in a straight line, right? Price will always go up, come down, go up, come down, go up, come down. And sometimes there's also the reversals. So basically, we want to take advantage of this overextended move to enter into credit spreads. This way, you will have a higher probability of succeeding, right? So what do I mean, right? So for example, if the market has kept going up without much retracement, then this is where you can consider entering into a bear call spread. And on the other hand, if the market has kept going down without much retracement, then this is where you can consider entering into a bull put spread, right? So the last thing you want is to enter, when the market is going sideways, right? Because as we know, if the market is to go sideways, then most of the time, this is the time where the market will find some breakout in either direction. Right, so that is why we want to first identify, the overextended move before entering into our credit spread. So the question is, how do you identify price extremes? Okay, so there are two ways that you can actually identify these price extremes. The first way is using the stochastic oscillator in conjunction with the price movement, right? So as you can see down here, this is clearly a very big move, right? By any standards, you can see that the candlesticks are so much longer than the one previously. You can see all these are all bunched up. And again, as I mentioned just now, whenever the price are all bunched up, this is when the price is consolidating, waiting for a breakout in either direction. So you do not want to enter a credit spread during this congestion. Wait for it to actually have the move. Then you want to confirm it with your stochastic oscillator, right? So as you can see down here, there's a big move down. Then you see that the market is oversold. Then this is where you can consider getting into a bull put spread, because a lot of the times, right, most of the time, but not all the time, most of the time when the market goes down with such kind of big moves, usually there tends to be a bounce back up again, right? So if you were able to catch it right at the bottom, basically when you see this overextended move and you confirm it with the stochastic oscillator, then you can enter into a bull put spread. Similarly, if the market is to go up, right, without much retracement, and you see that, hey, it's overbought, then you can consider putting into a bear call spread, right? So again, it's not going to work all the time, but it's going to work enough time so that, you know, at the end of the day, you're going to be profitable. Now, a lot of people have asked before, hey, Davis, what is the settings that you use for your stochastic oscillator? Can you share with me? So I've already created a video on this. So if you are curious, you know, just go ahead to my channel and just type stochastic, right? And you will see there's one video that I've already created on it. Now, the other way to identify price extremes is by using what I call the income grid. So income grid is basically my own way of identifying, you know, entries in the market, right? It's a very proprietary tool for myself. So basically what I'll do is I'll just draw these lines in the underlying that I want to trade. And I just want to see, you know, how much movement that it has made, right? Basically, I'm looking for the price movement to break through, you know, all these levels, right? So all these lines are considered levels. So if it breaks through many levels without much retracement, then that is where I would see it as being overextended, because most of the time a normal market movement would be bouncing back and forth, right? You can see down here it bounced back and forth within the different levels. So this is what I call, you know, generally this is a normal movement, right? So a movement where it's overextended is where it will go through all this level without much retracement. And then this is where you can consider getting into a credit spread, right? So if the market moves all the way up, you can consider getting into a bear call spread. And then if the market goes all the way down, you can get into a bull put spread. And in fact, this is a trade that I actually got in, right? I got into the short put version, not the put spread. And I actually created a video on this as well, right? Where I talk about how I use the income grid to find overextended moves, right? This kind of opportunities, and then just enter into the trade. So if you're curious, you know, about that video, you can go ahead again to my channel and just search for that. Okay, secret hack number 4, and that is stagger entries. Now, this is something that I don't hear that many people talk about. In fact, I haven't seen any video on YouTube that people talk about staggering entries. And basically what it is that if you have enough capital to trade more than one credit spread, now instead of entering all positions at one place, instead what you want to do is stagger your entries as the market continues going up or down, right? So I'm going to give you an example here. So for example, let's say you have enough capital to trade 2 bull put spreads. So instead of entering both at one time, what you want to do is you just enter one of them first, right? So let's say it's a 5-point wide spread, right? Let's say it's a 5-point wide bull put spread, and then you are receiving $1.50 for your credit. So if you receive $1.50 in terms of credit, right, what it leaves is $3.50 in terms of risk per put credit spread. So what it means is that your max risk per credit spread, per put spread, is $350. So let's say, for example, your risk per trade is actually $700, right? You can risk $700 on each trade. So instead of putting on 2 put spread, you could enter one first down here, right? Let's say, for example, you identify this as a setup for you to enter into put spread. So what you want to do is you enter one of them first. So let's say maybe this one is at 40 DTE. And then as the market goes down again, what you want to do is enter into another put spread. So right now, you already have your risk allocated, right? Because you have decided, hey, you want to risk $700. Now you have $700 for these two combined. So what you notice is that for the second one, I use a 55 DTE instead a 40 DTE. So what it does is that it adds further diversification into your trade, right? Because the first one is 40 DTE. So these two have different exit points, right? So if you were to use exiting at 21 DTE, then this will exit first, then this will exit later. So what it does is that it avoids the scenario whereby both could possibly lose, right? So don't forget, when we are trading put spread, we have time involved as well. So that means the market may continue to go down, but then it may not be 21 DTE yet. So at this point, maybe you have to exit this one first. But then later on, the market, as time passes, it actually goes up. Then now your second put spread is actually in a profit. So in this case, you lose one, you make one. At least you aggregate your P&L compared to if you had two contracts at this point. Let me just delete this drawing. Now compare this to if you have two contracts at this point, right? If you have two contracts at this point, and if the market does go all the way down, and let's say it's around 21 DTE already, then you're going to lose on both of it, right? But if you have staggered your entries in this case, then there's always a chance the second one is going to be in profit. And the best scenario is whereby both actually profit, right? This one goes down, and by the time it's about 21 DTE before you get out, this is profitable. All right, this will be profitable, but this second trade will be even more profitable because now it's even more out of the money, right? So again, this is how you can minimize your P&L volatility, and your results is going to be much more consistent. So by staggering entries, you are actually diversifying your entries vertically. So I talk about this in many other videos as well, which results in a smoother P&L compared to entering all your trades at once. Now, the last but not least, the last secret hack, number 5, and that is to stagger your exits. So we have already talked about staggering entries, but now you can also stagger your exit. So what do I mean by staggering your exit? So first of all, this is to be used in conjunction with the 21 DTE exit rule, right? So let's say you have decided that all your trades are going to exit at 21 DTE. Now, if you were to do it this way, what might happen is that if you're going to trade across many different stocks, you're going to find that you're going to have many positions that have the same DTE. So if you were to exit all of them at 21 DTE, it could be a little bit of a risk, so to speak, because what happens, if at 21 DTE, the market so happens to, be adverse to your position, right? It moves adversely to your position the last few days, and all of them is going to be in a loss, right? So if you're going to exit all at 21 DTE, it's like putting all your eggs, in one basket. But if you were to stagger your exits, what you actually do is you're going to minimize this risk, as well as your P&L fluctuation, your P&L volatility is going to be much more smoother. So you're going to exit them gradually as you get closer to the 21 DTE. So here's what I mean. So let's say, for example, you have put on 7 different stocks, right? So 7 different stocks from A to G, and they're all around the same DTE. So you pull up your positions tab and you see that all of them are at 25 DTE. Right, so instead of exiting all of them at 21 DTE, you start exiting them one by one, starting from this date, right? So maybe on this day, you close out one position first. Then you hold on the rest to the next day, and now it becomes 24 DTE. Then you close out the next one, right? Then you hold on the rest for another day. Then again, there's 23 DTE left. You close out that position. And again, you hold on to another day, 22 DTE, you close out that, so on and so forth, right? So gradually what you're going to do is that you're going to close the position slowly over time. And what it does is that it actually captures, your P&L at different stages, at different points in time, right? So maybe had you all closed out at 21 DTE, it could have been all at a loss, right? If it's all at 20 DTE. But because you have actually closed out one earlier, this could have captured some profit first. And then this one, maybe again, it's much more profitable. Then you're going to cap, much more profits down here. But then later, the market starts to take a downturn, right? Assuming all these are put spread, by the way. Then down here, maybe it's going to start to make slightly less money. And then down here, maybe you start to have, start to lose money again. Then down here again, maybe you start to lose money. Then the market goes back up again. It starts going to make money again. And then the market, really recovers, and then you're going to make more profits down here. By the way, all this are all dollar signs. Some people have mentioned, David, stop drawing the dollar sign. I know I should stop doing that, but hey, this is a way for me to show profits, right? So basically, when you stagger your exits, what you're going to notice is that you're going to have a much more smoother P&L, and this is also going to lead you to a much more consistent P&L, right? So this is not entries, this is exits, right? So this is what I personally do as well, especially, you know, I manage anywhere from 10 to 20 sometimes when the market gets very volatile. And this is where, you know, I want to stagger my exits. So this way I do not get all caught out at one point. Now, of course, if you're lucky, right, at 21 DTE, it could be the highest point of your P&L, but you cannot guarantee that for every time you exit at 21 DTE. So that is why instead of, you know, putting all your eggs in one basket, just gradually exit them. And over time, you will see that you have a smoother P&L, and you will definitely have much more consistent results because of this. So guys, these are the 5 hacks. Use them and let me know how it turns out for you. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.